Yeah, I mean, I think the volatility in the 10-year is something we're not talking nearly enough about. We saw that at the end of last week. And if you think about what could potentially be happening with jobs, we're seeing, slightly lower openings, slightly higher claims today. If you're looking at a non-farm payrolls, we're going to see moderation in that number. That's to be expected. But perhaps what you need to see is that you need to see indications that those wage pressures are starting to subside somewhat. Because, again, it's not just about energy prices. It's not just about gasoline prices in the consumer basket. It's about the margin pressure that we're starting to price in. We're all talking about earnings estimates. You have to think about how do those affect margins in the second half of the year. And so these input costs are very important. Wages are super sticky, and we need to start to see some of that wage growth subside. It hasn't been real, but it's been nominal. And I think that's going to be what we need to look at in tomorrow's release.
Keith, to you and then Joe, and then we're going to wrap it up. The idea that at this point, S&P is down 20%. And historically, people like you and Shannon and Joe have told people 20% from the highs is a good time to get into stocks if you're a long-term investor. Is this time different, or is it the same despite all of the issues that are in front of us?
Yeah. Well, we looked at that, and we think it's the same. Especially, you have to define time frames. On a 3-year basis, after you drop 20%, the market has been up 8 of 9 times, again, when you've dropped 20% from a record high. So from a long-term perspective, I think that's the case. On a short-term perspective, when we looked at the work, it really depends whether you go on recession or not, whether the market's up, say, 6 to 12 months later. So, again, I think time frame matters. We're still more neutral shorter term, but I do agree that if you're looking 3 years, 4 years, buying at today's prices is a good risk reward.
Until, Joe, you actually have to hit that enter button on that trade you wanted to make, although you did it on NVIDIA.
No, I actually think this is an opportunity. I think the first 6 months of 2023 are going to be a very strong one. We had to pay a price. We had to pay a price for all the liquidity, the speculative excesses, the leverage. We're seeing the price being paid right now. You can't ignore the inversions in the yield curve. Even the 3 months of the 10-year, that's collapsed 150 basis points. In the crypto world, you're hearing stories like 3 Arrows and Voyager. These are all the things that needed to happen, Scott. We're paying the price that we needed to pay. And I think the Fed is committed to doing what they need to do. Let's remember that.
Well, the question is, are we closer to the end than the beginning of that great reset of valuation in stocks, of, everything from SPACs and stocks to now, crypto and the crypto winter, and if that's coming to its close in the market and all of these markets can start to rebuild. I appreciate your time. It's good to see you in person. That's Joe Terranova. Guys, Keith, Shannon, I'll see you again soon.